Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you are doing well. In my last video, I spoke about how most of the negatives were priced in the auto OEMs. Let us talk about an extension to the auto sector, that is the auto ancillary sector. Now, did you know that a conventional car has 30,000 parts? Well, I am sure you must have heard the news of how semiconductor shortages has derailed the production schedules of all the auto companies. This reminds me of the importance of auto ancillary companies. So personally, I am very bullish on the auto and the auto ancillary sector. I mean, look at the skepticism around. Isn't it the best time to buy stocks? Anyways, enough of all this gyan. Now let's get straight to the point. I will be talking about two things in this video. One is which auto ancillary stocks should you buy, and second is which auto ancillary stocks you should avoid. Needless to say, these are my personal views and I have a right to be 100% wrong, or in fact more than 100% wrong. And also, before I start talking about the auto ancillary stocks, I hope you guys took my advice on Hero MotoCorp in the last video. The stock is up 10% in less than 15 days. Well, I continue to remain positive about the stock. At this valuation, there is nothing to lose. So anyways, let's get back to the auto ancillary stocks. Now, no future recommendation in the automobile or auto ancillary sector can be complete without focus on the electric vehicle ecosystem. After all, EV sales barely account for 1.3% of the total vehicle sales in India. Now, as per my view, the revolution in the EV sector is likely to capture the two-wheeler and three-wheeler industry first, followed by buses and passenger vehicles. The commercial vehicles, that is the truck segment, is immune to electrification at least for the next 5 to 7 years. So, in the auto ancillary space, my first bet is a company called Jamna Auto, which makes suspension systems for the commercial vehicle industry. Now, this Delhi-based company makes leaf springs, parabolic springs and axles for trucks, buses, tippers and trailers. The main purpose of a parabolic leaf spring is to spread the weight of the vehicle more widely over the vehicle's chassis. Apart from these products, Jamna Auto also makes axles, air suspensions and trailer suspensions too. In terms of revenue, 65% of its revenue comes from the OEM segment, while 33% comes from the aftermarket, which are high margin products. Exports account for roughly 1 or 2% of revenues. While this was the basic information about Jamna Auto, let us talk about 3 reasons why you should have a look at this company. Firstly, Jamna Auto has a 70% market share. This company supplies to almost all the commercial vehicle players, right from Tata Motors, who is the market leader, to Ashok Leyland, Eicher Motors and Bharat Benz, who are dominant players and account for more than 90% of commercial vehicle volumes in India. You name the CV player and Jamna Auto is a supplier of suspension systems to them. In fact, it is a sole supplier to Ashok Leyland and a major supplier to Tata Motors. Now, point number 2. In my view, EVs in the commercial vehicle space is a far-fetched reality. So that means there is no new R&D or product investment required for players like Jamna Auto. Also, EV or no EV, a truck needs suspension systems. It is not a replaceable component. And third point, lastly, automobile sector and especially the CV space is fraught with bad news. All of us know how badly hit the auto sector is, and it still hasn't recovered. I mean, in commercial vehicle space, we are still at 2017 levels. No movement for 5 years. If your bet is on the GDP and India, the best proxy is the CV sector. What better company to play than Jamna Auto? Last thing about Jamna Auto is the icing on the cake. Despite of the down cycle in the commercial vehicle space, you will be surprised to see the efficiency ratios of Jamna Auto. I mean, in a downtrend, the company has maintained a 3-year average return on capital employed at 22% and a 3-year average return on equity at 17%. Crazy numbers. Also, the company is a debt-free company. So even in the worst downturns, nothing can go wrong as you don't owe any money to anybody. That's probably the first rule of being solvent, right? Many of these auto ancillaries are struggling over the past 5 years. So this was the basic analysis of Jamna Auto. Now the issue is that the stock has already run up and is at a 52-week high. Obviously, there is no point looking at the historical price to earnings ratio, as when the cycles turn, earnings will more than double in a very short period of time and the price to earnings ratio will eventually look cheap. However, the point is that a lot seems to be priced in the stock. While it looks overvalued in the near term, any serious correction should be looked into. So that was about Jamna Auto and my pick in the auto ancillary space. Now let's talk about the auto ancillary stocks to avoid. Any auto ancillary making engine parts or fuel systems should be avoided. As the two-wheeler, three-wheeler and eventually the passenger vehicle market migrate to electric vehicles, who will the auto ancillaries making engine parts and fuel systems supply to? Companies like Bharat Forge and other forging companies will have to mitigate the risk by venturing into other lines of products. Also, company making fuel systems, when there is no fuel in the vehicle, what will these companies do? I know a lot of people are skeptical about investing in auto and auto ancillary companies. But trust me, this is the best time to invest in a sector when the sector is always unloved. This is how you create alpha in the long term. So guys, this was about the auto ancillary stocks which I had promised in my last video. Thank you for watching the video and do write to me what you feel.